number 3 is a slight discount, then it's always better to give the number 1. But the biggest money is made not by buying the best companies, but it's made by buying the companies that are turning better. So we buy the number 3 company, and you expected the company will change and suddenly start to show profits and give dividends. You can do that, but you cannot put too much money to work. And in my style of investing, I don't allocate small amounts of money to large number of companies. But I allocate large amount of money to small number of companies. So you cannot take a risk. So that is how it is. But if you have 20 companies and you think the sector will do well, then you should do buy both. Like what I did in 2003, I got both Pantaloon and Trend. And it took me 3 years to realize that Trend is not going to where I wanted it to go. And when I sold it, of course I made 6 times the money there. But by that time, Pantaloon was up 35 times, 40 times. That was not how much. So that is a trade-off which you have to make. So this is how it works. I don't think no Amazon. I think Flipkart would have come back. But because there is an Amazon, I think Flipkart has become more of a fancy trade. I don't know how. I will just forget it is Flipkart. Let's say some other company. It's not such a fancy name. I don't know how can you justify putting money in Flipkart. Basically what it is, Flipkart is in some, you are assuming that over the next 10 years, a certain percentage of the Indian population will only buy from the Indian. That is what you assume. And Flipkart gets its economies of scale because it buys in bulk and is the biggest distributor. But with e-commerce export and with Amazon coming into India, I don't know whether this kind of a valuation for Flipkart is justified. I think one, of course, but in investing, it is better to be wrong than, try and force your luck just to be right. So, if you have an option, I would not buy Flipkart. But if I had 50 companies and I had to allocate 200 to Flipkart, I would have allocated. Because it doesn't make a difference. Even if the company goes up, I will lose 2%. So, my answers, my thoughts are always in the context of somebody who has less than 10 companies. So, if you have 50 companies, you buy a Flipkart. But why not buy a Blue Dart? Because things have to be said. And Flipkart has its own courier service. I don't know if you know about it. They have its own courier service. And when I wrote this book, so I talked to Flipkart also and Amazon, and the kind of effort they wanted to put in just for marketing the book didn't seem to make sense to me. So I started selling it from my own website and it's doing well. So, of course, we don't dispatch to do that, but we've got somebody else for it. But I think courier companies will do it. If you just want, but now, Blue Dart, I don't know what PE rates are, 50, 60, I just don't know. 40, 50, 60. But one way to justify a high PE is to do 2 years ago. I'm not justifying it, I'm just giving the sense. If this is trading at 50 times 14, so look at it, how much it's traded, 16, 17, FY 17, FY 18. So this is how it happens. But I think on an overall scale, it's not a pickaxe and shovel doing. When I think there was a great gold rush in California about 100 years back, and everybody went digging for gold. So whether he found gold or not was uncertain, but he still had to buy those pickaxes and shovels. So if I just sold pickaxes and shovels, I would have made money. And that was the time Levi Strauss actually developed his jeans with very thick material. He said, yeah, this pant is फटेगा नहीं, लोग खोलते रह जाएंगे और मेरा pant भी चलेगा. And that is how the company was formed. So this is how you have to do. But pickaxe and shovel doesn't work all the time. There was a company called Tata Avaya, I think. And it really became Avaya Global. It was sold by Tata Telecom to Avaya Global structure. They were selling these call center equipments. And BPO was in a big boom in the early part of the last decade, 2002, 2003-04. But Avaya Global was a fantastic company to buy. But the problem with Avaya Global was the company transferred a lot of business from one company to the other company, and so he couldn't play. But most of the time, the pickaxe and shovel really does well. Like whether car sales is common or Amar Raja batteries has done well. Because after 3 years you need a replacement. So that's when the we can shout in the community. This is what you can look at. If you don't like Flipkart, doesn't matter if the e-commerce will do well, Flipkart will also do well. And when will e-commerce do well? Of course, we don't have it today in India. Suppose India, if India were not to import any Dell company laptops or computers, and there was just one company in India making and selling laptops and computers, instead of buying an e-commerce company, I would have bought that computer company. But in India, you can buy a Dell, you can buy a Lenovo, you can buy a HCL, HP, you can do anything. So that facility is not available for me. But what I'm trying to do is, from any sector move, you need not buy the guy whose valuation are at the maximum. Because of the internet boom, HDFC Bank benefited because it transferred all its systems on computer. So that is how it came. So whether you made money out of internet was or not were different, but at least if you got HDFC Bank, you would have made money. This is how it is. No, see, this is like a chicken and the egg race. Like I always say, borrowed conviction is more dangerous than borrowed capital. If the capital is borrowed, the conviction has to be original. But if the conviction is borrowed and the capital is original, then it's a problem. And if the conviction is borrowed and the capital is also borrowed, then you won't be there in the market for long. So, one way of handling this is to have your own conviction. It's very fanciful of you to say conviction, discipline, passion, commitment, thought, read, think. You think, I'm a thinker. I mean, who doesn't think? Everybody does. You keep many people I see on the post. What does he do? I take long walks and I'm a thinker. I didn't know, I am going to think about things. So, these words, they look good, put it on your profile, but nothing comes without success. Again, you've got to make money at every stage to have it, passion, conviction, belief, discipline, focus, but you're going to have success. You can't be there for 6 years, 7 years. So, on a shortcut, how it helps me, when I think about any of the companies that I have, of course I'm a thinker. So, I say, okay, I've got this company, can it go up 10 times in the next 10 years? If it will go up 10 times in the next 10 years, then I'm pretty much confident that I don't care. Somebody trying to make 50% in the next 6 months, let him make that. Because I have to make 10 times in the next 10 years. And most often, what happens is, you don't have to wait 10 years for that 10 time. When 10 time comes in the 7th year, and in the last 3 years, the stock does nothing. This is what because the market always discounts the future. So you need not wait for the 12th month of the 9th year and the 30th day and the 24th hour, the 31st day, and the 24th hour for you to make your 10 time. You should come to you 1 or 2 years before. And if you make your money before, the job has been done for you. Why do you have to wait so much? See, when you start with a small capital, my talk today and the suggestion over today, that we know people who have a basic level of capital which is around 25, 30 to 50 lakhs and above. But if you have a very small capital, say 2 lakhs, 1 lakh, what are you doing there? With 1 lakh, you grow 10 times, you go 10 lakhs. You grow 10 times, you go to 1 crore. So after 100 times rise, you reach 1 crore. And what assurity is he won't make money out of it midway? So these are things which you have to keep in mind that when you have very small capital, you have to arrange for it initial capital. P into 1 plus R by 100 to the power of n. Initial capital has to be arranged. It has to be borrowed or it has to be taken from somewhere. I can't say beg, borrow, steal, but something like that has to be done because it will take a lot of effort for you to move from 1 lakhs to 10 lakhs. And many people have this problem. Let me put 1 lakh and see what happens. And by the time they see what happens, They miss the big story. Because a good stock will not come to you every year. It will not come to you every second year. It will come to you once in 3 years. For me, the two big breaks for me in life has been Pantaloon Retail 2003 and Page Industries 2009. So if I grew my capital 40 times in Pantaloon Retail and in Page Industries it went up again 22, 23 times, so money is up 18 times. It's math. It's multiplication. But since the money in Pantaloon which I put upfront wasn't too big, considering, of course, no position is too big for a stock that is going up and no position is too small for a stock that is coming down. So, but still you think, it's always a relative thing. Try to put in maximum capital, and the moment you put in maximum capital, you will never take risk. Never take risk doesn't mean you will not invest, but you will always choose that stock which gives you 1 unit of return for a minimum level of risk. That is what we want.
So you are investing only for we have always said that we should have a diverse portfolio. How do you hedge that risk? Because you have said that you are investing in only one sector. So there is always a possibility that one sector, that particular sector will come in.
I'll answer this problem by giving a mathematical illustration. See, if I have 3 companies with 33% allocation each, and I expect each of them to grow by 30-35% every year. And by next year, one of those companies blow up. 0. Okay. No means 0. It's gone bankrupt. It's all. I still get it. Alright? Because 3% one company will go away. The other 2 companies, which are 33% allocation each, they are growing by 33% each year. So they will become 44 and 44, which is 88. My total initial capital was 100. This 33, I assume, has gone to 0. So in a year or 15 months or 18 months, I get my capital back. That is how I think. So every time, whenever I have an allocation, I always look at the allocation first. I always say that portfolio stocks, what you buy is not enough. How much you buy is more important. Because if you bought the stock, now if I have 3 stocks, and if I have one stock 90% and the other 2 stocks 5%, and the one with 90% goes up, then what happens? Those 5% stocks have to make money for the next 10 years just for me to recover back. And before that, whether I recover back or not, I will surely have a heart attack. So, the problem with having 2 companies, 3 companies, 4 companies, not the number of companies, but the way in which you allocate your money in between. So that the errors should cancel out each other or take care. And you don't expect to be so unfortunate that one of them goes bankrupt and you get 0 out of it. Because out of those 3 companies, you won't buy cyclically. People tell you buy 3 companies, you won't buy cyclically. You will only buy a company with some secular growth, with some kind of price predictability. You will look at a management, you will look at a sector leader, and things like that. So with that kind of a checks and balances and focus, I don't think there will be a situation where you will not be able to, where you will be at the risk of losing capital. No, I don't do commodities, no derivatives, nothing. No, because I told you that at the beginning that it's a very big ego hit to trade. Because if you want to be a good trader, you have to take the small losses. You make the losses, you cut it. You make some loss, you cut it. And you make a profit, you write it. That's the funda. But if you want to be a trader and you're not taking losses, then there's a problem. And if you want to be a trader, you have to take those losses. And I found that I started trading about 2-3 months back, just was 2-3 years back. Just for some fun to see what happens. But when I started, I found that it is getting very difficult because taking those 10,000, 15,000, 20,000 losses every time, it seemed that I've been pickpocketed each time I took a loss. And I couldn't handle it actually. So much so that I used to wait to go to the washroom before 2-3 times. Yeah, because prices were changing every moment. But the strategy in trading is simple. You have to cut your losses and you have to let the profits come. That's all. But then again, what matters is how much money are you willing to put on the table. If you have a portfolio of 100 rupees and you are trading with 50 paisa on the table, this is wasting time. But if you portfolio 100 rupees and you're trading with 20, 25 rupees on the table, then it's too much of a risk for a person like me to take. Because I'm already at risk. I am under some sort of a leverage always. I only have 4, 5, 6, 7, 8 companies. So, to compound problems, I don't want to go into this. That is why I don't trade actually. Recent nothing. Repco Home Finance was made last year. And the logic was since I had group finance and India right now has a shortage of 63 crore homes. Out of that, 50 crore this is in the rural and semi-urban. And thing with Repco is what happens is most of its customers are between the lower income to the semi-lower, I don't know. It's not urban crowd. It's mostly about middle income and lower income loan. So what happens is when they take a loan, it's their first loan, they're not married for investment, and most of them don't have documentary evidence to show that they're credit worthy because they don't maintain bank accounts. So this is what happens, and it's a 10-year, 20 year story. Of course, from the IPO price of 170, it's gone up now. Now it's 440, 450. But it doesn't matter to me, even if it comes to 40, it's so good enough. Because I have a 10-year view. And then you can change it next year. If the company does something foolish, like what will force me to sell off that code? If I get a sense that they are going to give in real estate and development goods, then that's a problem. Or if it comes to me that their average ticket size is increasing, then there's a problem. So, but otherwise, you just take the whole. But India Bulls housing says they will pay off 50% of the profits as dividend and also grow at 30% or something, which is theoretically impossible. How can we pay 50% as dividends? I think you must have read that formula, growth is equal to ROA into 1 minus. Right? So how can you actually do that? By giving so much to dividend and growing. That is only by improving efficiency. And efficiency can only be improved up to a point. You cannot do this for 20 years. So, of course, India was housing. That is sure. I'm not disputing it. I'm not disputing the numbers. But what I'm saying is it is very difficult for them to actually achieve what they are promising. But if they achieve, the stock will go up. Now, my thing is, if India goes up 3 times, then probably Repco will go 2 times. Because I can put more money to work in Repco. If I buy India Post housing, I won't be able to put so much money in India Post as I can in Repco. Because and there's always a factor of risk. So that is how I think. But you know also like demand housing like this. That is also cheaper. But you can't put that much money into work in demand because the promoter integrity, promoter group, that is also to come into force.
So you like to invest in the companies which are having higher market share and higher purchasing power also. Higher market share and higher purchasing power. So sir, if you can identify the bull runs in some sector, don't you think the small cap companies in that sector will grow at a faster rate than the market leaders in that sector?
No, the small caps of the sector never grow faster than the market rate, than the market leaders. What happens is, if you have a market leader, which is a small cap, of a sector which is growing, we have found a winner. Small cap sector leaders of a sector which is growing, it's a winner, rule out. But if a sector has a large market cap company and also small market cap company, it is mostly the case, a small fish never eats a big fish out. But that is how you have to look at it. But I've never found a situation where a small cap has actually become a market leader by pushing the large cap away.
Not market leader, sir, but rate of return of that.
Temporarily, till the time the bull market is in force. Like Nagarjuna Construction outperformed L&T from 2003 to 2008. Because Nagarjuna was a small cap, L&T was a large cap. But if you're not smart enough to sell in January 8, 2008, your outperformance vanished in the next 3-4 months. If you just go and check the charts and the prices, you will find that by April, May, June, L&T was outperforming Nagarjuna for the last 5 years. all the infra companies have still not reached their highs. But L&T has still reached, I think, all-time highs. Just crossed or it's thereabout. That's the only one. So, when you talk of safety of that, investing is not just about rewards. It's about making disproportionate rewards with very little risk. You cannot say I can do risk-free investing or I just want to do it. If you want to do it reward, then go buy Bhutan for lottery ticket. That's it. But if you're doing investing, why do you buy lottery tickets? Because just put 10 rupees off. You can buy a lottery ticket for 10 lakh rupees, you never buy one. You know, like that. 10 lakh book one. Last rupee, you find sometimes you pity the boy who's selling you lottery tickets and ice cream. Don't do that. That's how I calculate. And then when you give tags a slip to you, say, no, each may say no. Last may say, as if you know which number is going to come. But that is what we do. But when it comes to investing, the first thing, see, if you want to allocate large amounts of money to work, then please make sure that you can't say you can protect capital on that, but don't give any chance to the event of capital destruction. Just try and ensure that you can retain everything better. In the worst case scenario, what will happen? You won't make money, that's fine. But small cap stocks of a sector which has a large cap are very vulnerable when the tide turns. They are the first to lose everything. And then you have to see with the small cap, are they growing in increasing debt or are they growing without taking debt? Are they growing by permanent addition of capital or not? These are two things which will tell you as to how the story goes. With companies that are serial diluters of equity, the problem what happens in a bear market is there are no buyers for your equity. Nobody wants to put further cash. How do you grow? You don't grow because you can't issue further capital to those people. That is all.
Before we select any portfolio, any list of companies, before we say that this company will grow by this percent or something, we have our figures. But when do we set the stop loss? When do we think that we have to let go of this company? When do we actually sell?
See, this is the thing when to sell.
Yeah, but we know that company will grow. We have done all the hard work and we bought the company. But then when market is fluctuating and when
the first thing is, normally you should not sell unless there is something inherently wrong with it. But if you get a better opportunity, you should sell the stock. If you get a better opportunity. Finding the right stock, as I always say, it's like finding the right spouse. Once you've got them, let them remain. You don't look for a new spouse and but if the spouse doesn't act the way you want them to act repeatedly, and you're sure that is not going to grow, then you have to take some action. Now, how can that happen? First is which doesn't happen properly, which is you look at it as relative aspect. Many stocks I have sold are because relatively they look inferior to a new opportunity. Like I sold Zydus Venus in 2010. It was really okay, but I thought that Hawkins page, of course, page had gone up by that time, 2, 3, 4 times from initial price. But I thought they would do well, so I sold Zydus and got paid. No reason specific to sell Zydus, just get paid with them. Second is when the market cap reaches a certain size. When the market cap becomes almost equal to the sector revenues. Right? You know it when it happens. Like PVRT in 2007 when I sold had a market cap combined of 5,000 crores. It's not too much at that time. And of course the stock came crashing down from there. But I didn't know that it's going to come down. I just thought market caps are out. So I sold and bought Axis Bank because Axis Bank had a diluted equity at that time. Third is you sell when there is a government action. Like I sold Titan last year. The stock is gone up 80% after that. Because the government cancelled gold loan fees. They said gold loan fees we won't allow. So that was a big blow to Titan's business model itself. But since then, when Titan went up, the government reintroduced gold loan fees. The price was at 300. So Titan is okay. But then I sold I don't want to put it in. Then you sell because of management action. I bought a stock called Quantum Reach in 2009 March. So at that time it seemed that Quantum Reach was a good company. But then the day I bought it, there was a news flash after 2, 3, 4, 5 units or thereabouts. if the company is putting 41% into a power company, subsidy or power or something. So that was my decision because I got the power equipment company. I didn't want to be invested in a power company, so I saw immediately on that. So then sometimes you have to sell for a reason which did not happen to you when you bought the stock. You can put Zydus to this because Zydus was growing its Nutralite business, marginally which you say, the low calorie butter or no butter, no calorie. It was growing at 20 and 30%. Then when I met the company at the AGM and things like that, then I got a sense that it was growing at 20 or 20% because Amul was on strike. So they said if Amul is able to produce full flow, then we can only grow at 15%. We can't grow at more than that. Which came as a surprise to me because I was planning that this company will grow at 20%. And that time, so that was a new event which came to me because I had not known about it. So why I'm explaining this to you is because just from my experiences, I can. Then sometimes you sell because you fear that you will lose market share. That is when I sold Pantaloon. My average purchase price is 7 rupees. It went up to 875. I sold when it came back to 300. Because when it came to 300, I read that Peter Lynch has lost 99% in Ferrima and Ferrima. So when Peter Lynch can lose 99%, I can also lose. So, and why did I sell Pantaloon earlier? Because there was a spin-off trade in TV again where I tripled my money and Pantaloon was planning to spin off. It was a big bazaar, it was like Future Bazaar, and this bazaar, and that bazaar. I mean, none of the bazaars could be sold. And the stock came crashing down. And that is how it is. So, it's a confluence of various factors. But if you just focus on one thing, you get a better stock, you sell the old one. That's it. That's it. Don't try and unnecessarily excite yourself by saying okay, my purchase price is 10 rupees, now it is at 100, so what if it went to 150, what do I lose, it is still at 100, I bought it at 10, don't do that. Your purchase price is irrelevant from the moment the trade has been executed. What matters then is the market price, the price that is free and free. Basically the purchase price should be substituted by the last traded price of the stock of the scheme. That's all. That is what matters. So these are things, but basically none of us are fortunate enough to sell at the top. And none of us are fortunate enough to buy at the bottom. But then if you sell 10-20% down from the top, 30% down from the top, and you made money in a trade, and you make so much money that the regret of not having sold at the top will never happen to you. Of course, at that time, what happened is, when the stock hits 300 and comes to 250, then you can't sell. You say, when it goes back to 300, I will sell. Okay? But if it goes back to 300, mind you, it will go up to 350 again. And the price at which you want the stock to go back to before you sell almost never comes. If it goes back to that price, I will sell. If it goes back to this price, I will buy. These two prices never come to us. They just exist only in our mental calculations, and the market doesn't care. Market doesn't care like what price you want to buy, what price you want to sell. So we can all have our own theories of buying and selling. But I think the best thing to do is find a better stock, sell out. And that time you don't, and it might happen that one day before, we would have given a 3-minute lecture to somebody in a railway platform as to how long you should hold it for the 10 years, for the next 10 years. But you get a better stock, you sell. Doesn't matter. You want to maximize money by minimizing risk. So that is what.
So this governance issue, you believe that bargain hunting is
It's very difficult to answer, but these kind of stocks normally should not. Bargain hunting basically means there is a corporate liability. If the entire banking sector wants to withdraw money from vision scheme, how do they do it? And Jeffrey Associates just did a QIP and the promoters came and sold their own stock into the market. So the promoters themselves are bearish. Now promoters of Page Industries are also selling. There are other promoters, Narayan Murthy also kept selling. I mean, Infosys many directors kept selling. The stock went going up actually at that time. But what you have to understand is, promoters selling frequently on ESOPs is not an issue. HDFC Bank officers are selling for the last 15 years. Every time you open it, you find some guy coming and selling in ESOPs. Yes Bank also has the same situation. But Bhushan Steel, Jayaprakash Associates, there is a certain amount of fear in them about the market. When that is the case, of that from 38 to if you buy JP, you go to 55 also. But you can't put too much money to work first. And secondly, even if you buy a small amount of it, it won't make a difference to you if it goes to 20 or it goes to 50. That is my theory. But generally, given an option, I will not like that. Normally, I don't like to buy stocks which come down like this in the backdrop of bad news, which isn't just market. In Bhushan Steel, there is no new market. They actually caught in some CBI issue. Same with JP. Otherwise, everything's not going to So, how can you actually become bullish on
There
them?
was a few 650, then the market went up.
Which one?
Satyam.
Oh, Satyam, 650. No. From 6 when Mahindras got in, that time it went up. But those trades are, see, for every Satyam that goes back to 60 from 10, there will be 20 different Petromedia in BSQ that will go back to 60 paisa from 10. Because this is one off. We have seen 20 companies. One of them, Satyam, has gone up 6 times from 10 rupees. Okay? And the other 19 from 10 rupees, they will come crashing down on me. Like Bhushan Steel, it will go up, but the other is. So, after the trade is done, after we have known what has happened, we can say, okay, we missed this. But then they say, you can't regret what misses in the market. It's better to miss something where there is even a small amount of risk. See, I always keep every fourth or fifth sentence I talk is on correlation risk. Because that has to be controlled. If you can avoid losing money, you will make a lot of money. You have to figure out how can I avoid losing money. Just if you can figure out how I can avoid. I don't make money, I don't mind. I will stay in this thing. Whatever returns I have made personally, I think because except for a broadcast episode, I have not put myself into a problem most of the time, but I missed several opportunities just because I didn't buy it. And that's fine.
You trade in international market.
Oh, oh. You don't have any, I don't have any idea of interest. But I'm reading somewhere, look at the Mongolian stock market, if you guys do some research. They say by 2019 they have identified some gold and Rio Tinto is getting into it and the GDP will go up 5-7 times. I don't recommend any of you to invest there. But just for your own exercise if you can, just do Google search, spend 2 hours on this on the Mongolian stock exchange, and just do a nice, good looking report. And show people that you guys have done something different. Because these are things which you have, this is what makes money. Mongolian stock exchange, they identify large amounts of gold. What the biggest risk there? If gold is comes crashing down to $800, then nothing will happen. Those people will abandon their mines. Here, but if gold stays at this level, I think the GDP will go 5 times or 6 times by 2020. GDP, not individual stock. And there's also a very good, nice Mongolian index. You look open a Wikipedia, you find a list. Of course, you can't pronounce most of the names, and you can't read the others, but okay, it's good fun to just see what's happening around. Another country that some of my friends went to was Vietnam. They went wrong like that. What do you do if you go to Mongolia or Vietnam? What do you do? What companies do you? What can you do? What companies do you? Huh? You guessed? Best thing to do is buy the index. Because you don't know how you will burn your fingers. We can't understand Indian companies. How do you understand Mongolian companies? We just know what is Mongolian nation, how it is. Apart from that, you've heard of Genghis Khan. And there was a Great Wall of China built. You don't have a fourth idea of Mongolia. So what you do is, you buy the index. First thing. And with this Mongolian, Coal India, ONGC, NTPC, SBI, KNK, a perfect patriotic Indian. But you will make more money if you buy it. Whatever, like you have got granules in there. You don't know only granules. What is this? Whenever you can explain your stock idea to 10 people without speaking one more word, just be sure that stock is not going to do anything. You tell Coal India, nobody say क्या करती है. You say granular unit क्या है? What is this? What does it do? Good. Let the suspense remain. So that is one way, but I have seen people normally they like to think of these big picture stories and say India is short on power, India is short on coal, India is short on oil. And you know one thing which you will do in these research reports, India's per capita consumption of paper is only itna gram, America's consumption is itna kgs. India's per capita consumption of electricity is only itna units, America's. That difference will always remain in all sectors because our economy is 1.5 trillion maybe perhaps and their economy is 14-15 trillion. So 10 times difference is normal. When there is a range of per capita, our population is almost 4 times theirs. So 10 into 4, 40 times is normal. So if you are 2.5% of anything that they do, it is just normal. Don't get excited, relax. But you read any research report, you will always say, India's per capita consumption of so and so, cigarettes is so and so, America is so and so, Taiwan is so and so, Singapore is so and so. You will always talk, Singapore smokes at night when he is sleeping. But you have to understand it in that context. If the population is more, and secondly the GDP is less. So obviously that difference will always be there. But these are the very nice ways to actually market a story from a sell side analyst perspective. When they write the report, they have to give you different acha aisa bhi aisa dekho, acha par capita dekho, degree dekho. ITC looks very good to me. I haven't got it, I will not buy it because market cap is too high. But at 22 times FY16 PE, ITC doesn't look bad. But it is not going to make your problem. Means, if you want to speculate, you can buy it in futures and roll it over. I don't do it, I don't recommend it. But ITC is not a company where I put my own money to work because we want to look for faster rates of return. But ITC doesn't look bad. I think it's got a good liquidity also, in spite of everything. So instead of in Coal India and think something bad about Indians. Don't think that Indians will get power and electricity. Think that every Indian will smoke. You get more money there. And look at ITC. The kind of excise increases, they pass it over. And how much? Classic. And it sells at 10 rupees now. But in ITC, you can buy, better to buy the business, don't buy the product.
Do you value stock?
Value stock in the sense?
Technically,
From DCF and
No, DCF. No, I don't do DCF. I know how it is done, but if you ask me to put it on an Excel, I don't know, I struggle a bit unless, because I have not done it for years. I've got a very different perspective of evaluating a company. You tell me a company like that, how I will do it. Just give me any big company where I have some idea.
Reliance Power. Reliance Power, yeah.
Okay, listen. Reliance Power. The first thing in my mind is cyclical, non-cyclical. It's a non-cyclical. The power is continuous. There is a regulated, non-regulated. Regulated in what sense? You cannot increase power rates. And regulated in the sense, what is the problem? You can't get coal. But then how can you make money out of this company? You can make money. How can you make money? You can make money if its installed capacity is X megawatts or whatever, and it is currently doing only 0.2x or 0.3x or 0.4x. So your money making opportunity is limited to the extent of its uninstalled capacity, which is not put into use. Okay, then you move forward and you say, how about the management? Trustworthy, you not trustworthy. No comments there. You can't trust it. So then what do? You see what is the track record? Track record, you don't know what it is. So then there is a problem again. So instead of Reliance Power, flip the name of the company. Put an NTPC here. So your management, you move ahead. Okay, government is the management, it's not a problem. Operating, you will do well. So a power company will buy only if I get it at a certain level of its installed capacity. I will not buy it if the installed capacity is the capacity that they are generating right now. So that is it. Then I look at the balance sheet and you see debt, how much. But if before I go to the balance sheet, these things come into my mind with 2-3 no's, then I'll say there's no point. Of course you don't see it, but this is the quick analysis that I do. And then of course, once you look at the balance sheet, then you can frame a better opinion on it. But this is the analysis that I think doing a DCF is good for power companies. it's good for companies with predictable cash flows. But you can't do a DCF for 80% of India's companies because they don't themselves know as to what they want to do next year. No, not before making, but maybe after. No, the reason is because most of these are small caps. If you wait to meet the management, then you are sure, then you're not sure as to whether you get the stock. So you buy some, you meet the management, you buy more of it. See, the stock has to scream to you from a distance. It need not have to come and whisper to you in every ear. It has to scream to you and say, this, I will go up. You want to buy it, you buy it. So then you don't need too much of analysis. You have to buy some of it, it will be the management, it will be buy more of it. Yes. Very good. Very good. BSD is better than ITC in a sense. ITC uses all its spare cash to blow up in these biscuits and chips and those things, but BSD uses that cash to liquidate after investors. No, different segments. Different segments. I'm not such a great expert on this. So that's not because I don't use those products. But because I think if you upgrade from the PD, you go into the BSD customer point. They will give the length of the significance. But BSD is for the retired guys. Why do you want to do this? They are dividend. And see, once you have to see the EBITDA margin, I think is 30-35%. You can't go beyond that. So if I get a BSD with an EBITDA of 18%, I will buy it. And hold it till I get an EBITDA of 35%. Because they will not grow sales at 20%. They will not sales at 12, 13, 14% only. And if you get an EBITDA of 30-35%, then there is very little chance of a margin expansion. Most of these low moderate growth companies should be bought only when you think they have a chance of margin expansion.
So what do you feel about companies which are already not listed or maybe going back 2-3 years like a Red Bus or a mineral water company or a segment?
Well, a good mineral water company. I haven't bought it, did not recommend it, right? You want to talk about Korean beverages. पता है तो बिस्लरी का स्क्रीन क्या फ्रेंचाइजी है 11 करोड़ मार्केट कैप है नॉट कंट्रीब्यूट मनी बाय द हां no 11 look at the market cap forget how much it is gone up 11 crores you have bislary steel cap franchisee so what is the question
a company like Red Bus or companies that are not already listed do you like
but Red Bus is good I don't know. But the problem with the private equity guys is if they bring it to the market, in the bull market, they will ensure that you don't make it. The best time to buy an IPO is when there is a bear market. IPO is not to be looked at, it's probably overpriced, always, as people say. You talk to any smarty, it's IPO it's probably overpriced. Any smarty will say. But if you thought that Infosys was an IPO, Page Industries was an IPO, Bharti Airtel was an IPO, IPO doesn't like that, any stock is an IPO. But IPO means from within 1 year of an IPO started giving you returns. Jubilant Foodworks was an IPO. So you cannot, but these were all IPOs of a bear market. IPO of a bear market is a great opportunity. But IPO of a bull market, if Red Bus comes next year or the year after next, I don't think it's going to be very for bull market. Snowman is good, but I think they will list at 60-65 and not leave anything for the investors. 20 rupees.
What happens if company management say for next number of quarters or a year the company grows really slow and probably they are not sure but it might go back to the original high growth rate later.
No, I will tell you how you figure it out. If the scale of opportunity is very large, then they will go back to it. But a company whose sales growth slows down never actually goes back to it. So from 40% they will come to 20%, 20% they will come to 25, from 25 they will come to 20. They probably stay there. But from 40 they come to 25, they don't normally go back to 40. Over a secular period, you go back to quarter to quarter, but you don't do that. So, it is, but you don't need to consider it all as to what is the scale of opportunity and how many times the entire market is or the present revenue that the company is. Now, in most of these cases, the data that you get is itself unreliable. Like how many pressure cookers are sold in India? Who knows? There are so many companies in Delhi who make a pressure cooker in a small area and they sell it to the unorganized market. They don't pay taxes. So you don't know how many pressure cookers there are. So in most of the cases, data is not great, but even the broad data of how things are, you get a sense as to how much this company. In order to where you have to invest in a company where you get a good dividend yield. Company with a stated payout policy is more than these things. But if you have a company which is investing in good companies, I saw a lot of problem at the when I heard that I met very late, they invested into a Honda. Because you don't want one of your companies to subsidize the other. If the other guy needs money, let him go to a banking board. Why should you buy from a borrow from a rich company?
So what are your sources of research? Do you use any paid database?
No. It's not free. Company annual reports. First thing is, you just see the annual results, and then you go to the annual report, and in one annual report you get last 5 years of data. So you go back to the 2009 annual report, you can say 2004, or 2014, which is the last 10 years, good enough. That is one way. But I don't, because I don't do frequent line and service. So, to that extent also I think it is not better not to have too much of these specific news-based information devices on your desktop. Because every moment they will flash something, otherwise for what are they charging you 1 lakh rupees a year? And most of this data is not worth relying on so much. Because suddenly they say, one problem with the US is every second day they come out with a new data. Which one will you rely on? You say new home, old home, middle home, rented home, people who don't pay rent, burn homes. I mean, so much confusion. What do you rely on? So that is one thing, and mostly my investing side is very simple as to you know this company will grow. It's a like Asian Paints, who can deny that it will not grow for the next 10 years? It will grow. But just how much money you will make less, make more, that's the thing. It will make that.
So the last investment you said you made a year and a half back. So
No, the last new investment. You keep buying also, huh, with the new money. But the last new idea, and it's not that I didn't find a new idea. You find a new idea all the time. But is that new idea good enough for you to replace one of your old? First question. Second question, if not, then on its own, absolute basis, new idea is good enough. But my thought is, can I sell any of my existing ideas to buy this? That is how things are.
So how much do you invest?
You can. Let's leave that.
Why do you have to sell the old idea? We can.
Why do I have to sell it? Because unless you sell an old idea and you have fully invested, you can't bet enough. Unless you can bet enough, how is it going to change your balance sheet? You give me an idea, right? Say, you value it as something. But say you leave work, you have a nice network, can you put 30% in numbers in here? 30% of the network. So how we know? 11% okay. And then if you put 2% to the same question, it goes up by 100%, your overall network goes up. You get 2%.
That much conviction you already putting in
That is what I see. My style is very different. Like I tell you 3 more thing which I do is, which very few people do. And, like one of them is, I buy all few stocks. I don't buy too many. It will appear that I am taking too much of risk. Secondly, I am always worried about risk. I don't know how many times I will talk about risk over here. I am always paranoid of risk. So one way of avoiding risk is why I own only a few companies. Because I am sure that they will not go. If you give me 20 companies, I will have very little idea for each of them. It's like a mother having 20 kids. Who should be achieved? This को दूध पिलाया, इसको नहीं पिलाया. Like Pakistan marksheet आया वहाँ से स्कूल से. But here I know I've got 4 kids. In 1 month, all 4 have to come with their quarterly results. So show me your marksheet, show me your marksheet, show me your marksheet. That's it. My job is done. Thirdly, I bet with leverage money. Most of the smarties that are here, no one ever use leverage. Use leverage to buy a car, which will go down in value every year. But don't use leverage to buy a stock which can go up in value every year. Use leverage to buy a home, which you will never ever sell in life. But don't use leverage to buy a stock which can buy several homes, if you get it right. So, this is one more difference. Thirdly, even though I can afford to spend, I don't spend too much on things, irrespective of whether I can afford it or not. Irrespective of that. It just doesn't give me that feel-good factor. So these are things which I do just because I feel comfortable doing it. But over time, you will understand every person has his own strength. Like you tell me a company, I say, we're discussing a company. Suddenly you say, cash and balance sheet, 400 rupees per share, stock price 500 rupees. That's a short one. Why? A company which cannot put cash to use, you think it's going to create value for you for the next 10 years. You can get that 500 rupees stock to go up to 700, 800. But I don't want to play that game. I want ideas which are 500 rupees stock can go to 5,000. That is the hope in which we live. I'm not sure whether that hope will be achieved or that dream will be achieved or not, but at least सोचो ना ऐसा. 500 stock उसको 5,000 में yes. And it's better to take a hit, like it's better to hit a 6 or a free hit, a no ball. So you do one hit, there are free hits, no balls. 9% India's GDP there, it's not on it. You can say they might not go at 30%, they might go at 25%, they might go at 35%, they might not go at 40%. That's debatable. But will they grow? They will not. You just have to, you will probably have to leave it for 2, 3, 4, 5 more years. That's enough. But you will get through it. But another problem with the young investing community is, I would say problem, it's a misconception is, everything that they want to do is copy-paste Warren Buffett. You know, Warren Buffett bought a candy company, Seas Candy. Anybody know the last 40 years top line series here? Last 40 years top line series. 10%. 10% for the last 40 years it's been growing every year. Did you ever buy a company in India if it came to 10%? You not. But why Buffett manages to do it? He has float. It is zero cost capital. The insurance company throws back money into it. So if he can get 10% out of it from 0% capital, the spread that he is making is 10%, which SKS Micro used to make when it was at its peak. So Buffett has to be very sure I don't want to lose money because I want to buy it in Washington Post. Buffett holds the stake there. Right? Anybody knows the CGR top line? American Express. Go and check up. Wells Fargo. CGR isn't too much. Why doesn't Warren Buffett, why did he buy Google? Why did he buy Microsoft? Why has he bought Burlington? Burlington is the name, no? Railroad company. Yeah. Why did he buy that? Because he cannot afford to lose with somebody else's money. This is something which nobody talks. You say, see, Warren Buffett, he's done that. And Baba, किसी और का पैसा है उसका खुद का नहीं है भाई. He cannot afford to lose. And he's very smart at it. So if you have an insurance company, then you can look at a 10% top line CGR growth company. But it's your own money, you have to grow. You have not borrowed it. And then you say, never borrow. The world's richest stock market guy has made money from borrowed capital. What else is flawed? You tell me what else is flawed? It is somebody else's money. Just go float people and just do Google search. Warren Buffett's float. You get several articles there. What happens is when you get an insurance check, you get a premium upfront, and you expect that the day the person gives you a check, you will not die on that day. You will take a few more days to go to. So for that time period, you can use that money. And he puts that money into a pakka business, where there is no chance of failure. So he goes and buys hens, and he goes and buys companies like, real solid companies. But then there are people who will say, I will not buy technology companies, even though I will work for a technology company, just because Warren Buffett doesn't buy technology companies. There are people. If you can understand technology companies, why won't you buy them? If you're working in a pharma company, why won't you buy it? And most of the online discussion is hyped up. Mr. Buffett did that. And then how retail investing community has to think like Mr. Buffett. If Mr. Buffett has made his capital, just read his letters from 1958 or thereabouts. He did all kinds of business, arbitrage, this, that. He made a partnership firm. Very good people. So he had to got his revenue, earning ability right up front. And it's our own money. So it's good to have knowledge, but it's not that good to apply all the time because circumstances change. You cannot have a similar set of circumstances under which Warren Buffett works, under which Peter Lynch used to work, under which Benjamin Graham used to work. You can't have that. Benjamin Graham was born, he was active in a time when US was in a Great Depression. He said, I don't want to buy a company. I want to buy companies that sell at 2 times and net current assets or thereabouts. Why? Because then I might be able to close down the company and recover my capital. That is all. You are welcome to Calcutta. I can ensure that you will get a company to have net working capital. Try and close down the company. You will not be able to. Things have changed. Union Army help diyega. They are not ready to do anything. So, environment has changed. In 1929, there was so much of chaos. US GDP contracted 25%. So, at that time, all his thought was, let me get my capital back. You can't open up a Benjamin Graham textbook in 1996 and analyze Amazon.com. No. Because he didn't see Amazon. Had he seen Amazon, we don't know what he would have said. Then there's this fancy of scuttlebutt. You are aware of scuttlebutt? It means going and meeting distributors and dealers and retailers of a company product or finding out what the company, whether the company is making money or not. This fancy of scuttlebutt. And again, a problem. You want to do scuttlebutt in a company that has been in existence for 20 years again. You want to ask people on the regular platform. It's not done. Scuttlebutt is done in the initial stages. When people are not sure, or in the case of a turnaround company. So, one investing principle cannot be applied all the time, everywhere. Not possible. My principles, or rather, sorry, I can't say principle, my strategy can die maybe after 2 years, 3 years, 4 years. It's working today, it's working. When I started, I was a little more ignorant. So I got pantaloon. I said, okay, negative cash flow, I don't care. It's growing, not okay. But then strategies change. And you have to, strategies change because the environment changes, the circumstances change. You cannot have one single strategy and always find out new companies there. So that is the problem. Another problem is that most people, when they try and put US-based investing knowledge to work into Indian conditions, don't know that Indian markets work in a very peculiar environment. Here is a company whose shareholding pattern shows that FIIs already own 74% and they can't go beyond 74% or 76% or whatever. Right? The stock price refuses to go up. Because if the FIIs can't buy more of that stock, who will buy? It's just like saying people from Maharashtra, including Mumbai, cannot buy this stock. Who will buy? People from Balasore and Odisha. It's not possible. The FIs are the biggest movers of the stock. So this nobody will know. You will have to figure out what is going on. If this stock has hit 74%, and if there is no, why is it industry bank and HDFC bank going down? In stock price, not in terms of profitability. Because the FI notice will hit. They'll have to be in here. And ठीक है, whether they get it increased or not is a separate issue. It's a separate issue. But and again, what they say, generally when you read those offline internet, I've got a lot of things for you because most of the news, most of the knowledge is borrowed, and that borrowed knowledge works to self-destruction, right? Anything which is above a PE of 10, 12 is expensive. And 40 PE means you are ready for a nosedive into an abyss. It's not like that. The PE will continue to be at 40 till the you have to be more sure about the growth than you are unsure about the PE. The surety of the growth matters more, and the surety and the PE will remain there. PE won't come down. But if you are sure that both will not stay there, then whether it's PE of 40 or 25, sell it. It's going to compress. And once growth slows, it rarely ever goes back. Because growth only slows when you have saturated the entire market. And one way of knowing whether the company is slowed down its growth is to see whether the company is ready to do an acquisition. If the company is ready to do an acquisition, you can be very sure that growth is slowing. T&L, when it saturated the entire Indian market, it went and bought an African company, same area. Right? Suzlon, it went and bought RE Power. Right? Suzlon, it got so many things that you didn't know what to do with any of them. Tata Motors, Tata Steel, went and bought Chorus. So, whenever any of these commodity companies go for an international acquisition, you can be sure, Apollo Tyres, of course, when was later removed away, they will be bought. So you can be very sure that the story is almost getting saturated. But if a brand acquires another brand, then there isn't too much to be worried about. Normally what I say is, normally the shikar is more valuable than the shikari. So if Imami has bought Zandu, then you won't buy Zandu. Don't buy Imami. If Suzlon buys RE Power, you won't buy RE Power. If Tata Motors buys JLR, you won't buy JLR. Because you paid top dollars to get it off. Because when you negotiate, when these guys negotiate these deals, then the rate which is set is almost the highest. And the guy who writes a check says, okay, doesn't matter, I won't make money for 2 years. Let me write a check. I want this. It gets into his ego. So things like that. So, but if you have acquired a brand, then you don't have to sell this one. Like when Tata Motors acquired JLR, it worked okay. Imami with Jandu Pharma, it worked okay for them. But Suzlon, Punjab, Tata Steel, Hindalco with Novartis, acquire another company at the top of the cycle. Because at that time your balance sheet doesn't have too much debt, you have cash with you, and from the top, cyclicals always turn around and come to the bottom. So by the time the acquisition is complete, the cycle changes for you. And then what happens is, you're going to take a further debt, you don't have cash, and you have to make good also. And there's an integration problem and many different issues arise at that time. So, growth companies, you need not be ignored just because the PE is high. And there are several other aspects also. There are two growth companies, one growing at 30%, the other growing at 40%. But the one which is growing at 30% has a 70% payout. I will be more sure of the 70% payout. Because growth without capex, that means high ROE. That's a wonderful thing. Then what is their target market? If one company shows growth by selling, say, cement, and the other company is growing by selling, say, whatever, let's say, tomato ketchup. And obviously, tomato ketchup is less immune to cyclical swings. So that is better. It's a confluence of events, but PE ratio by itself is not to be looked at so critically as most people do. Because, here, Most of the time, just like I said now, this is not Newton's law. We can't say that anybody who buys a stock at a PE of about is destined to lose money, and if he doesn't, well, you can't. Right. So, this is how it is. Liberty is good. There is another topic of relaxo in this space. That is also good. And there is another part water. But again, I answer will be biased because if you want to form 25 companies, then you can buy a million. If you want to own less than 10, then I just cannot go beyond Bata. Which one? No, Bata is doing very simple things. See, the problem with Bata is, it has to grow same source cells of the. So when it puts up a new store to grow, it incurs rent cost, administrative cost, and lighting costs. So that doesn't add to bottom line. How it can grow by selling more from the same stores? That they are doing. Have you visited any Bata store out there? Go and see, the designs are changing. They're carrying more ladies' handbags and things like that. They go more money. But Bata won't grow at more than 20%. 15-20%. Why I'm trying to tell you about Liberty and Bata and Ranchi is the number of stocks you really have or the percentage allocation you want to make also decides as to when you should leave a stock, even though the potential returns could be higher in the market share you make. Because you just cannot afford to lose. No, I didn't I paid interest to bank and then years. No insurance. I think that beyond the point, there is no need for person to take insurance. Why? How much will you take a health insurance for? 2 lakhs, 3 lakhs, 4 lakhs, 5 lakhs. Medicare health insurance. And if you can afford that kind of an expenditure through your own resources, then why take your insurance? But life insurance, till you reach a certain set of assets in terms of whatever, land, property, gold, you should have. And that you should focus on term insurance. But many people will tell you, term insurance, what happened? I paid a premium, I get nothing in return. What do you tell to those people? The only way to make money from a term insurance is to go and die. Otherwise, how will you make money? But don't commit suicide in the first year. I think you don't accept suicidal claim in the first year. Because they expect that anybody who is frustrated with life can't wait for 2 years before dying. So, but if you want to take insurance, take a term insurance. I take an insurance, term insurance, in 2001. But after 3-4 years, I paid my further money. And I've taken an insurance, because it's okay. I used to pay with 4 installments. So I used to say, sir, you don't do any more policies with me. Why are you doing it in this 4 installments? What you do is you give one single check for a year, writing up 4 times. I told him, if I die in the first quarter, will you give me back the premium of the second, third, and the fourth quarter? You won't. So if I die in the fourth quarter, then only I recover all the money back. Understand what I'm saying? So my idea was, now you can say it makes no difference, but when I think, I say, why should I